I invoked your name yesterday, Tom, because I said even the bullish Tom Lee said that the January rally borrowed from February. So you're still expecting a tough, few weeks here, months? What's your time frame?
Yeah, I think investors should expect some payback. I mean, we had one of the best ever Januaries, and if you look at the 7 years that mirrored what we just saw, it's going to be tough in the second half of February to early March. But it doesn't mean the full year. I think there's no thesis change. I think this year is still going to be a story about how inflation cooling makes the Fed data dependent, not data reactive. And that means volatility is expected to fall both for yields and for equity risk premia, and that's why stocks can rally.
So I'll just play devil's advocate on the inflation thing. The market has been so focused on inflation because the Fed has been so focused on inflation, and the Fed is not convinced that we've seen a sustainable decrease in the inflation rate. So why wouldn't the market sell off every time there's evidence that inflation is harder to squash?
I mean, I think that's kind of what happened in the last couple of weeks. Everyone saw January data a little hotter, and they think the Fed's going to jump on that. But prior to that, we have to keep in mind we had 3 good inflation prints. Powell invoked the word disinflation 13 times in his press conference. We get the minutes today, and if we see more comments than that in the meeting, I think it allays fears that the Fed...
But that's old news. Since then, we have seen evidence that it might not be so disinflationary.
But the economy doesn't pivot. So when people say the economy, if inflation's flaring up, I mean, that's assuming the economy hinges on like a matchstick. And, I think there were a lot of January seasonals affecting that. And at the end of the day, gasoline's already rolling over, and if natural gas is tanking, and Carl pointed out lithium's tanking, and housing continues to weaken. I mean, both sides of the inflation story are, and that's over 60% of core, is deflating.
And you've pointed out shelter obviously lags the most.
Yes.
And if that really does, say, react with a 12-month lag, then this summer is going to be, we all got disinflation without it. What's disinflation going to be like with it?
Yeah, that's right. Let's say that the 60% of core is either 0 or negative, including housing going negative. You can't even get 2% inflation with the other 40%. So, I mean, I think you might be printing 2% inflation starting in the summer.
You made the point that a tough Fed doesn't mean the stocks have to go down with every inflationary data point. You point back to Volcker or even Arthur Burns, I think. But a transition like the one that we're in the midst of, from the zero bound to wherever we're going to end up at a terminal rate, is there anything that is, can you really make that connection to that period in the 70s?
Yeah, I mean, we just published a piece on this that if you look at the 14 rate cycles that lasted more than 12 months, 11 out of the 14 markets rallied into highs with the hikes. The 2 exceptions were during Burns, when he was higher in a hurry. But actually, once Volcker became Fed chair, believe it or not, hikes were associated with higher stock prices. And of course, in Greenspan, there were 5 cycles of his raising. 5 of 5 times markets marched higher to all-time highs. So unless Powell is invoking Burns, I think the stock market is going to appreciate data dependence. I know people talk about equity risk premia is at an all-time low, but that's because inflation risk premia is at an all-time high. That's what's embedded in interest rates. So if inflation risk falls, yields will fall and equity risk premium is actually going to jump. So
unless we